Join me as I take on the challenge of figuring out how to save $200,000 in capital gains taxes and boost my wealth. Let's see if I can actually make it happen. Capital gains taxes can be a significant obstacle for individuals seeking to grow their wealth. If you're investing in stocks, real estate, or any other assets, you need to understand how these taxes work and how they can affect your financial goals. When you sell an asset for more than you bought it, that's a good problem to have. But it also means you'll have to deal with capital gains taxes. These taxes can really add up, and if you're not careful, you could end up losing a big chunk of your profits. Imagine selling a property or a stock and having to give up 20%, 30%, or even 40% of your gains to the government. That can be a huge hit to your wealth. The thing is, most people don't think about capital gains taxes until it's too late. They make a profit, and then suddenly they're facing a big tax bill. It's like getting a surprise bill in the mail. It can be really frustrating. But the good news is that there are ways to minimize these taxes. And that's what I want to share with you today. By understanding how capital gains taxes work and using some smart strategies, you can keep more of your hard-earned money. You can use it to invest even more, grow your wealth faster, and achieve your financial goals. There are actually several strategies that can help you reduce your capital gains taxes. One approach is to use tax-deferred accounts, like 401ks or IRAs, which can help your investments grow without being taxed until you withdraw the money. Another strategy is to invest in opportunity zones, which offer tax benefits for investing in specific areas. You can also consider investing in tax-efficient assets, such as index funds or municipal bonds. But here's a powerful tip that could save you a lot of money. Consider holding on to your investments for at least a year and a day. By doing so, you can qualify for long-term capital gains treatment, which can significantly lower your tax rate. For example, if you're in a high tax bracket, you might pay 40% on short-term gains, but only 20% on long-term gains. That's a huge difference. To give you an idea of just how much you can save, imagine selling an asset with a $200,000 gain. If you're paying 40% in short-term capital gains taxes, that's $80,000 going straight to the government. But if you qualify for long-term capital gains treatment, you might only pay $40,000. That's $40,000 more in your pocket. So, to recap, capital gains taxes can be a major obstacle to growing your wealth, but there are ways to minimize them. By using tax-deferred accounts, investing in opportunity zones, and holding on to your investments for the long haul, you can keep more of your hard-earned money. If you've had any experiences with capital gains taxes, good or bad, I'd love to hear about them in the comments below. And if you're interested in learning more about wealth-building strategies, be sure to check out my other videos. I've got a lot of tips and tricks to share.